Hello, everyone. Thank you for joining us. My name is Marcia Butler, and I'm the webinar director at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Just a couple of notes to our attendees. You are on mute, but we do encourage you to ask questions using the chat box. And let me go ahead and make sure that feature is turned on. You should be able to submit your questions there. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during this event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to our presenter today, and let me go ahead and get your picture up here, Darcy. Darcy Smoot is a principal with Nelson Capital. She has extensive experience in equity analysis and securities trading. Darcy graduated with a BA from Swarthmore College, majoring in mathematics and English literature. She began her career at Bloomberg LP in New York City, and in 2009 went to work as an equity derivative sales trader at Susquehanna International Group before joining Nelson Capital in 2014. Darcy is a chartered financial analyst and is a member of the CFA Society of San Francisco. Well, Darcy, we're excited to have you here, and this is a great topic. I'm really excited for it. Let's go ahead and get started.
All right. Thank you, Marcia, and thanks to everyone who's joining. One little disclaimer, I just want to say I will be kind of applying sweeping generalizations to women as a gender group, but hopefully this webinar can offer some helpful solutions to anyone of any gender who identifies with these issues. So getting started with our first topic, which is a familiar concept, the gender pay gap. Per the recent data, a woman makes on average about 84% of what a man makes. And this is even when we consider those working full-time and year-round. The inequity is even greater for Black and Hispanic women. And unfortunately, education is not enough to eliminate the gender wage gap. So generally, wages do go up with more education, but there is a significant gap between what a man earns and what a woman earns at every level of education, from less than a high school diploma to an advanced degree. Women in each category still make less than their male counterparts. In fact, on average, women actually have more education than, or more years of education, and are more likely than men to have completed associate's, bachelor's, or master's degrees. But because of the wage gap, women have to complete an additional degree in order to be paid the same as a man with less education. Historically, the gender wage gap did narrow significantly from about 1960 to 2000 as women entered the workforce en masse. But since 2000, for the last 23 years, the narrowing of that wage gap has slowed, has really stagnated. I think that the causes are, and we could probably do several webinars or a series just on this topic alone. And I think the cause is really, it's kind of impossible to scientifically measure. There are resources that do attempt to do that. It's probably a combination of things, whether women are more likely than men to work in lower paying jobs with fewer benefits. There may be limited career advancement opportunities because women are pulled more significantly into family obligations. There could be some degree of gender discrimination, but whatever it is, women's labor is undervalued. And that's not my opinion. That's actually the characterization from the Department of Labor's post on this subject. But it's a problem. It results in lower lifetime earnings, reduced savings, less disposable income. And as we know, I think the root of most financial issues is not having enough money. So what can be done about this? I think some of the points here are things that I wouldn't necessarily just recommend to women alone, but research what the market rate for your job description is, and then negotiate. Ask for more money during the hiring process and during performance reviews. For a new job, consult a resume advisor to really make your experience shine. Come to performance reviews prepared to offer tangible examples of your contribution to the company. I think maybe a more female specific piece of advice, I think women tend to very generally tend to be a little bit more deferential, a little bit more non-confrontational, and maybe a little bit more afraid to ask for more money. And I just am here to say, do not be afraid. A good employer is not going to see that as a drawback or a red flag. In fact, it's a sign of confidence that you know your worth. So that's really, I think, piece of advice number one is ask for more money. I think also seeking career development opportunities within your firm or outside of it, seeking out mentorship, network, and training opportunities. These are ways to not only build your knowledge base, but it also is a way to gather information about market rates for your job. And it also creates tangible examples that you can point to in a performance review. So those are ways to address the gender pay gap. Next slide. So delaying saving for retirement. Many women do delay saving, delay putting away money for retirement. We could, as far as why, we could just pull the gender wage gap slide up again. With lower earnings and less disposable income, of course, saving for retirement is going to be more challenging and probably delayed. Women can't invest money when they don't make enough to keep up with the cost of living today. So really ask for more money. But other factors at play behind some of these statistics, that 68% of working women are saving for retirement versus 82% of men, might come from, again, a general lack of interest in money or finances, maybe a little bit of a head in the sand mentality about saving for retirement. And it's really important to break this if this describes you. Women owe it to themselves to get into the weeds on this, to start saving for retirement and to take control of their financial future. Because again, if not, it could mean missed opportunities for growth and less long-term financial stability. So again, what can we do about this? Aside from asking for more money, which I think I've drilled into everybody now. Start saving early, even if it's just a little bit when you're starting out. And the reason to do this is because of the beauty of compound interest. And actually, if we could go to the next slide, I just want to go through one example to kind of go through this. If we consider two hypothetical investors, investor A starts at age 25 and invests $100 per month. Investor B starts at age 35 and invests $200 per month. So starting about 10 years later, but doubling the contribution. Both earn 8% per year on their portfolios. And Marcia, do you have that next slide handy to go to that example? So both, here's kind of the facts that we went through. So how much do they have at age 65? Investor B still has not caught up to investor A. I think compound interest it's an example that, or it's a fact that is kind of a simple concept. You invest some money, that money earns some money, and then the money you've earned earns some money, and so on and so forth. But I think it is really mind-blowing when you see these kind of tangible examples of what does it mean to start 5 years earlier or 10 years earlier, even if it's just a little bit of money that I can put away. I do want to be clear when I say saving money, what I'm really talking about is contributing to a retirement account. I'm not talking about putting that money in a bank savings account, which doesn't earn any interest these days. Even with interest rates up, there's no interest to be made there. Contributing to a retirement account like a 401k that your company might offer, or a 403b if you work for a nonprofit. There are other types of retirement plans like a profit sharing plan or cash balance plan. But the IRS gives incentives, including a tax deduction for most of these retirement contributions. And many companies will also offer matching on whatever you put into your retirement account, your 401k, they'll match it in some form or another. So whatever you can contribute early on is not only going to benefit from that compound interest that we talked about, but you're also getting these possible matching and tax benefits. If you don't have access to a 401k or 403b through your company, you could also open up an IRA, which is an individual retirement account. You can open that up at a brokerage, Schwab or Fidelity, anywhere, and you could start contributing there. And there might even be tax incentives available for doing that if you don't have the option through your company. This is another example of compound interest and kind of reiterates the same point. In this example, somebody is starting to invest $5,000 at age 22. Somebody starts a decade later. We're using the same 6% growth applied for both. And at age 67, the early saver has almost double the savings accumulated. So again, I do think when we get kind of put the numbers on paper to see what compound interest really means, it's eye-popping. Okay, family-related career interruptions. This is probably not surprising. I think most of the participants here are probably women or identify as women, but women do take on a greater share of household and caregiving responsibilities, including caring for children, elderly family members. And this is kind of related to the idea of the mental load that women tend to take on, even when they're also working full-time, or even when they're the primary breadwinner in a relationship. And as much as we don't want it to, it can impact the ability to work full-time, to pursue education, and to earn a steady income. So unfortunately, I think women often are penalized for taking on this load. Add to that the fact that, the US has no paid family leave, and it's the only industrialized country in the world that does not guarantee paid family leave. There are 8 countries that don't guarantee paid family leave. And aside from the US, the other 7 are island nations in the Pacific Ocean, it's truly embarrassing. No disrespect to any of these island nations, but the US is far and away the largest economy. We've not figured out how to offer any kind of paid family leave. I think in some regard, remote work has made it a little bit slightly better to kind of balance some of those responsibilities, but it's not a perfect solution. And furthermore, I think a lot of firms are pushing a return to office, which is really taxing women who are taking on these family and household duties. So what can be done about this? Honestly, this is trickier. I think to the extent that you can, make a plan with partners and other family members to figure out how all of this work is going to get done, and so that you can also excel in your career. You know, I think, again, in general, women may tend to be hesitant to ask for help, and you have to ask for help. You can't be afraid to ask for that when you need it. I think it's important to lean into your support network, and you know, really it does take a village, and I understand some people don't have immediate family nearby, and that makes it extremely challenging. And if you don't, you know, one piece of advice that I might offer is to get to know your neighbors, throw a block party, introduce yourself to people who live nearby. You know, you might be surprised how willing people are to help out. But I think, you know, making clear what your career goals are, figuring out how you're going to achieve those goals with the, and asking for the help from those around you who want to support you. I think it's really the best thing that we can do. All right, too conservative of investments. You know, I think that this is, again, kind of a Finance 101 or simple reminder that risk and return go hand in hand. So if you want to have more upside potential, more return potential, it does mean taking on more risk. Women are more likely to save than men, but they're often more cautious in their investment choices, investment portfolios, and sometimes that can come at the expense of portfolio returns. There was a Wells Fargo study that asked women and men, you know, how aggressive are you, or, you know, are you willing to take risk? And the most conservative bucket of people said they were not willing to take any risk in hopes of generating high returns. That was 9% of the women and about 6% of the men. And I think that, you know, it's important to remember that there are times where it may be appropriate to have a little bit more risk and return upside in the portfolio. So when we think about what can be done on the next slide here, I think seeking out financial education. Webinars like this are a great place to start, but really kind of getting aware of what does it mean to take on risk. You know, I'll use the example of a retirement account for somebody who's maybe in their early-ish stage of their career, maybe in their 30s or 40s. When you're talking about a retirement account, the horizon on that money, you're really not even going to touch that money until you're probably 60, 65. So with that long time horizon, you may think to yourself, I'm really a person who doesn't want to take on much risk, but the reality is you probably should take on some in order to allow for the potential for those funds to grow over time, especially because you can sustain a downturn in the near future. You don't need those funds for another 20 or 30 years. So I think that's kind of, there are times where it is appropriate to take that risk, and seeking out those educational resources is an important step towards getting comfortable with what does it mean to take on that risk. I also think engage a financial advisor who can help guide you to that appropriate asset allocation, help you achieve your goals and set the appropriate amount of risk and diversification within your portfolio. And then finally, realizing the importance of investments that outpace inflation. When we think about that, you know, most conservative bucket, that 9% of women who said they're not willing to take any risk whatsoever in order to achieve achieve returns. What that means is, I think, I equate that to sticking money in cash. Cash won't lose anything. But it is essentially, if we consider inflation, which is currently running about 5%, the long-term historical average of inflation is, call it 2.5%. Cash is essentially losing 2.5% to 5% each year as it's just sitting there and inflation is moving higher. So it's important to remember that in the calculation, and it's another reason to kind of open up your mind to maybe taking on a little bit more risk. not saving enough for longer retirement and healthcare needs. So women tend to live longer than men. I think the most recent average life expectancy in the US for women is about 79 years. And for men, that's about 73. So women need more money to pay for those 6 more years of living. I think that also could mean more money for healthcare and long-term care needs. When we work with clients to portray a cash flow analysis to make sure there are enough resources, we do notice that the living expenses will be indexed to inflation, so growing every single year, even though as people age, they get to a certain point where they really don't want to accumulate any more stuff or buy any more things. But we don't change those numbers because there is sort of that wild card of healthcare and the expenses that come along with that in those later years. So I think it's important to kind of remember that that projection out towards 80, 90 years of life expectancy, making sure that you have kind of the funds in place to care for yourself during that time. So kind of address this a little bit, but having that financial plan, that's really crucial, I think. I can't stress that enough. I think a good financial advisor will go through this with you at least once a year, more often during those life transitional moments, whether it's a divorce or a death of a spouse or some kind of pivotal moment. But that's a really important part of the puzzle, is to make sure that you have a financial plan in place to sustain your life for your longevity. Prioritizing preventive healthcare, I think, is very important. And then again, talking with the financial advisor about tools that you can use to prepare for those long-term needs, whether it's a long-term care policy or just making sure that you have that cash available. I think that's all part of the saving for retirement and healthcare needs. Okay, so carrying too much credit card debt. I looked up a national debt relief survey, and that actually found that 66% of women carry credit card debt, compared to about 33% of men. So again, we could go back to that gender pay gap slide. I think credit cards are often seen as a way to backstop finances instead of saving in advance. They're kind of that last line of defense. I have seen cases from time to time where women have their savings that they built up in their bank account and they don't want to touch those emergency savings, but they will go into credit card debt. That's a mistake because credit card rates are extremely high. We talked about the beauty of compound interest when you are saving for retirement. That cuts the other way when we're talking about credit card debt, because with rates upwards of 20%, that debt is going to rack up much, much faster, and it will compound if the credit card balances are growing. I think, again, other factors that are maybe out of one's control, divorce, widowhood, those might strain finances and kind of force somebody to go into credit card debt. But it's to the extent that you can avoid this. We can talk about some of those ways on the next slide. Planning spending in advance, making sure that those large one-time expenses are accounted for, whether it's a car repair or a home repair, something like that. That's kind of the best thing that you can do. You definitely want to pay down at least the minimum, but if possible, you really want to pay down the entire balance of your credit card bill every single month. Building that credit is important, so you certainly use the credit card, but make sure that if you have to, take the emergency savings and pay down the credit card debt, because you don't want to be paying those credit card rates. Avoiding high interest rate credit cards is certainly something you can do, but even the lowest interest cards are in the range of 15 to 25%. So there really aren't any real good low interest rate credit cards that we know of. So I do have some final thoughts. I think we've talked about the gender pay gap that's come up a lot. I think that there are intrinsic and extrinsic factors that kind of stack the deck against women when it comes to finances. And therefore, I think it's extremely important to take control of your financial future in the ways that we've talked about in this presentation. And really, I guess I might be a little bit biased here as a financial advisor, but I do believe one of the best ways to do this is to meet with an advisor who can help provide that advice that's tailored to your situation to help you achieve those financial goals and make sure that you're on the right track to doing so. So any questions?
Yes, I have a list of questions here, and we'll ask our attendees if they have more questions. They're welcome to put that in the chat. So this is a question about retirement. What if my spouse is contributing to his retirement for both of us? How do I know if that's an adequate amount?
That is a great question. I won't be able to answer it without knowing the rest of your situation. And I do think that is, again, you should probably get in front of a financial advisor to understand, is this enough? Do the projections put you both in a good place to retire? The other thing that I would just mention is retirement accounts are I think that we all want to stay, we get married hoping that we do stay together, but I think it is probably a good question to say, hey, just what if things go a different way than what I'm expecting? I think, again, making sure that you've got your own financial security is something that is important and can be asked in a very happy, harmonious marriage. So I would also stress, the importance of that, getting that question answered so that you're not blindsided someday in some horrible situation down the road that isn't probably likely, but just to be extra safe.
All right. I'm an independent contractor. How do I get started saving for my retirement? We don't have a 401k.
Great question. Yeah. So probably the best tool, again, I would consult a financial advisor, and I would also consult a CPA, a tax accountant, but probably the best would be either an individual 401k or a self-employed plan, which is often called a SEP IRA. So there are contribution maximums that often are quite high that allow independent contractors to put away money for retirement. And again, there are tax benefits to doing so. And again, putting that money away and having it compound and grow is definitely the biggest upside there. So I would look at those two, but again, consult a financial advisor on what is best for the type of employment income that you have.
And just a follow-up question for that. What about contributing to a Roth? Is that possible?
Yeah, great question. And I think that's another topic that we could spend almost an entire webinar on. But just for those who are unfamiliar with a Roth IRA, there are two types of retirement contributions. You can do a pre-tax contribution. It's often called a non-Roth contribution, and that's where you're getting a tax deduction upfront, saying to the IRS, reduce my income today. I'll worry about the taxes when I take it out in retirement. And the way that works is just like we said, you get the tax deduction on your paycheck for this year, 2023. You put the money into your retirement account. It can be a 401k, an IRA, SEP IRA, anything. It grows to some point when you're ready to ultimately take it out when you turn 72 or whatever it is. And when you pull that money out, it's taxed as ordinary income to you. On the other hand, a Roth contribution is the opposite. You're telling the IRS, tax me on this money today. I'm going to use after-tax dollars. I want to invest it today, and I want that to grow. And when I take it out at age 72 or whenever I want to, I'm not going to be taxed at all. So there will be completely tax-free income. both Roth and non-Roth retirement accounts are eligible for no tax on the capital gains. But when you take out those non-Roth contributions, it'll be taxed as ordinary income, as if you were getting a paycheck from a company. Whereas Roth funds will not be taxed at all. Now, to get even more into the weeds here a little bit, there are limits on what you can contribute to a Roth IRA. Often, if you have a company-sponsored 401k plan, you may not be eligible for a direct Roth contribution. However, currently there are some loopholes. The most common is known as a backdoor Roth contribution. And some companies have started to kind of offer this as a way to get some funds into a Roth IRA. The way that works is you make an extra contribution to your IRA or your 401k or whatever it is, using after-tax dollars. And then, a month or two later, after you've made that contribution, you do a conversion, a Roth conversion, where you take some money out of your IRA and you put it into the Roth, and now it's in your Roth IRA. The other point to consider is it's not, it sounds really nice to put money into a Roth and grow it and then have no taxes on it. And often that's a great tool that is the right tool for people. But again, I do think it's important to talk to a financial advisor about your particular situation, because you may, accountants like that and say, oh, you have to do that because there's compound interest and then there's no tax. And they're right to that extent, but there are other factors such as what are tax rates going to be when you ultimately take this out? If you're 35 years old today and we're talking about when you turn 75, we have no idea. It's too far in the future to predict what politicians are going to do to tax rates. But if you're planning to take time off or retire, or you might have a lower income year where your tax rate might be lower, that might be the time to kind of build up your Roth savings rather than while you're in a really high marginal tax bracket today. So I know I've gone pretty deep into the weeds, and I'm sorry for, but
that's okay. Maybe that's what our next webinar needs. So we talk all about Roths. We did have another question about, as long as we're on it, we did have another question about Roths. So what's the difference between like a Roth 401k, I guess at work, and an IRA Roth account?
Yeah, great question. So I would categorize this differently, or I would kind of think of it as this, an IRA and a 401k. 401k is a company-sponsored plan. An IRA is an individual retirement account not sponsored by a company. In both of these two types of accounts, you can have a Roth IRA or a non-Roth IRA. Traditional is kind of what it's called. You can also have a traditional 401k or a Roth 401k. So the Roth identifier tells you whether it's an after-tax contribution or not. And then a 401k identifier tells you it's a company-sponsored plan, whereas an IRA is an individual plan. So it's confusing, I realize, but Roth is a term that signifies after-tax contributions, and it can be applied to any different type of retirement account, whether it's company-sponsored or individual.
This is an interesting question. Do you have any advice about returning to the workforce if you've been gone for a period of, say, more than 5 years?
Yeah, that's a great question. I think that a lot of the bullet points from the presentation are still going to apply. I would say the optimist in me likes to think that there are more women in powerful positions at companies who understand the challenges that women go through and the reasons that women often might step out of the workforce for 5 years. So I think that you don't have to hide it and say, you can be upfront about, I was helping raise a family, or I was helping caring for an elderly relative or something like that. I think you can certainly be upfront about that, but whatever you can do to kind of build those networking opportunities, attending webinars, attending conferences, or getting into a particular LinkedIn group that has people that are, in the industry that you'd like to work in, kind of like being proactive about reaching out and establishing those connections. I think that stepping out of the workforce for some time is a realistic thing that lots of people do, and it doesn't make you any less eligible or qualified for a job. So but it does, I think, make you more motivated to build those connections and establish that network so that you can kind of put out the feelers and getting yourself back into the workforce.
All right, and a final question here that'll kind of wrap things up. We've mentioned about financial advisors, and this person wants to know, what does working with a financial kind of look and feel like? Can you describe what that process is? And
yeah, absolutely. I think that's a great question, and I think it's I almost want to say every financial advisor has kind of their own flavor or specialty, but in general, I think I can kind of talk to the two services that we offer, that I think is probably a pretty similar model for lots of different advisors out there. We offer two services. One is asset management, which is investing the assets on clients' behalves, discussing with them the right asset allocation, of course, and then kind of choosing the investments to implement that plan in their portfolios. That's the asset management portion. The wealth management portion is definitely, I think, what clients see the most. I would argue that they probably see the most value in, and that is everything that goes along with creating that holistic plan to help you achieve your financial goals and make sure that you're constantly on track to do so, and to really get into the weeds with you and help hold your hand through, like I said, those transitional moments. They're not all bad. It's not just death and divorce, but selling of a business, re-entering the workforce after 5 years, having a child, those are all those different things that can change the plan completely. So I think that there are, and we've come up with kind of a menu of services that I can touch on some of the major points here. I think investment planning is, reviewing the portfolio and looking at asset allocation. Cash flow and budgeting is helping you understand what are your living expenses, what are your one-time large expenses that you're planning, kind of building out a wealth analysis, a balance sheet, so you know where are your assets and liabilities. Want to consolidate everything in one place. Projecting out cash flows, projecting out returns on those investments, incorporating the taxes. I think on that note, there's tax planning that can be done from, do I do a Roth or not? I have stock-based compensation. What does that mean? What choices should I be making on the equity compensation that I've been given? And then I think beyond that, there's also risk management, making sure that you're covered from a risk standpoint, as far as, do I have the right insurance for my net worth, for my home, for my car. Retirement planning is, of course, part of that. And then estate planning. Do I need to be setting up a trust? Are there estate tax mitigation techniques that we should be putting into place? Making sure that guardianship is in place for minors. And then, assistance to loved ones, helping pay for college, helping care for the elderly, anything that goes along with divorce planning. I think it's so broad, it's hard to give a great example without knowing anything about the person who asked the question. But, think of it as kind of a holistic plan that will address everything that touches your financial life. I do have people who have asked if I ever feel like a therapist, and I do think that there's a bit of that, because it's a little bit meta, like, what is money for? So there's also that, I think that some people I think I've said this before, but some people have goals to accumulate a large amount of wealth and pass it on to their heirs. And some people want to bounce their last check. And that's fine. Neither of those is right or wrong. It's just we want to understand what drives you and what are your goals and help you achieve them.
All right, well, let's go ahead and wrap up here. We want to thank our speaker and the organizations that have worked with us to bring you this webinar today. Thank you so much for attending, and look to an email soon with a link to the replay of this event. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.